Good evening. My name is Peter Reznicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, April 18th, 2021. It was exactly March 13th when I came out with a video called 7 Reasons Why This Market is Going Higher. Obviously, since then, we have gone much higher. And this video is going to delve into some of the details under the hood that are both underpinning that rally and also potentially working against it. But I'm going to let you guys draw your own conclusions. I'm going to get very granular and look under the hood, and we're going to be talking about a lot of market-generated information and nuance. And my goal with this video is honestly to take your understanding of market dynamics from here all the way up to here in the hopes that you can actually apply that information to your own trading and investing next week. On top of that, we're going to round out the video with a short piece on gold, Bitcoin, and Coinbase. All three of these instruments are kind of in play right now, and I'm sure that people want to know how I feel about them technically, so I'll be going into those charts as well. All right, without further ado, let's get into it. So in this first section of technical analysis, we're going to talk about the three majors that we usually talk about: S&P, NASDAQ, 100, and Russell, and we're also going to throw in the Dow. So let's start with the S&P. The uptrend is obvious. You don't need me to tell you that. We have been moving in one direction for about 13 or 14 sessions now. I think the only nuance here that people need to pay attention to, obviously, is the distance from the 20-period moving average. If you recall, this is a measurement that I started taking many, many years ago when the S&P had a one handle in front of it, right? When we were at S&P 1500 or whatever, and I said that when that extension from the 20 MA gets to about 50 points, that's when things get dicey and the odds of a pullback or at least some sort of consolidation increase greatly. Now, obviously, as the S&P has grown in size, that distance from the 20 MA can get bigger without the market snapping back. But I just wanted to point out that right now, that distance in here is 152 points. So it's pretty high. 152 is historically pretty high in terms of how far the closing price is on Friday from where the 20-period moving average is now. So I want you to just keep that in mind. That does not mean that the market is definitely going to come in next week. It's just one data point, but it is one to remember. All right. Other than that, on the S&P, I like the stacking of the MAs. They look good. This trend line is obviously no longer in play. We don't need it. If anything, the next trend line that would be in play in terms of a short-term one would be this one. And I do also want to point out that even from this very short-term trend line, which is where the prices would be closest to, there is a good deal of overextension. So again, a little bit of sideways activity and digesting all this would be okay. We also have a whole number coming up, which is noteworthy. Notice that the high on Friday was up to 41.91. Usually market will not pause unless it, before it touches the number. I wouldn't be surprised if we tag the 4,200 early in next week. All right, let's move on to the NDX. NDX had a very important technical level this week. You can see these are the 5 trading days in question. And why was it important? Because for the first time in a while, it took the all-time high. Remember, we've been focusing a lot on the S&P having an all-time high, but the NASDAQ 100 just did it. I like this pattern in a nutshell. I will just say it is classic, like little W here that kind of led to higher. You can look also at this as a cup. And now if there's going to be a handle, the most healthy handle would actually be to have a slight downtrend to it just like that. But my main takeaway from this, and this goes kind of hand in hand with the whole ruling reason thing that I touched upon in the intro. My big takeaway here is that this is not the type of pattern that the market would just fall out of bed out of. There's, you have to understand what type of patterns tend to set up downdrafts and what type of patterns don't set up, downward moves. And to me, this is a pattern that doesn't really set up a downward move. If anything, I'm expecting the NASDAQ 100 to consolidate and sort of get a better handle on this 14,000 area and build some value in this section, more than likely. That's the outcome that I'm seeing. Let's move on to the Dow. Let's leave the Russell for last. Looks good, not even overly extended from the 20. You can see not even that much space here, just sort of riding it. I think everything is just fine with the Dow. We don't pay too much attention to it because it's such a narrow index. And last but not least, the Russell. And here's where the pattern is somewhat different. notice that you can look at this in one of two ways. You could say this is a classic head and shoulders pattern, which would mean lower, or you could say that it is what we call a W pattern, meaning it's just a classic double bottom, which usually means higher. I think it's going to resolve to the upside. One of the reasons I think that is the simple fact that when you look at the way that this head and shoulders formed here, the Russell didn't take the opportunity that it had here to move lower. As this right shoulder sort of bent over, instead you had a reversal bar here and then you're moving up. So your key area in the Russell obviously is going to be this level, and I'll just mouse over if you want to jot it down. It's 2280.83, so call it 2281. If the RUT can move over that level, then what it will do, because it is the last prior high before this pullback, then it increases the odds that it will sort of grind up to that 2360 level. So overall, as far as this TA is concerned of the majors, there's not really a lot to talk about here. Everything is grinding higher. Patterns do not look like the type that the market would fall out of, except for the S&P. You have to understand that in this time of great divergence, and that is kind of a bullish thing, which I'll talk about more when I get into sectors, in this time of divergence, it's only the S&P that looks overextended. To me, the other ones simply don't have patterns that would lead to lower anytime soon. Okay, market profile. Here's where things get a little more granular, also in my book a little bit more exciting, and also really tell us so much more about the nature of the buying and selling rather, and what the market is actually doing than you could get from any other source. And I mean that in two ways: from any other source of charts, or probably from any other news source. I firmly believe that what I'm about to tell you, you probably will not hear anywhere else, or if so, probably only a very small handful of people are talking about it. But it's really the key to understanding liquidation breaks when they occur, what keeps the market going, what are the signs that prove that a market is actually bullish other than just making higher highs. A lot of people just look at green on the screen and they say to themselves, oh, well, the market is obviously bullish because it's making higher highs, right? But when you bring that extra element of time in and you can look at value as opposed to just price, you can have a little bit more proof than that. So I'm actually pretty excited to talk about the profile in this segment for all those reasons I just mentioned, but also the fact that if you haven't yet started to create a narrative every day using market profile theory, this would be a fantastic time to do so. And what I'm about to show you in this video is a classic example of how that narrative works, of all the different data points that you put together, and you just keep carrying forward until they get violated, basically, right? You have a data point, and it remains a data point in your narrative until prices will trade back through it in some fashion. So let's take a look at the profile in detail. And the first thing you're going to notice is that I've put a lot of markings on them, or on it rather. I've labeled all of the virgin points of control, which I haven't done in a while. By my calculations, we're up to 11. I may be off by one or two, or maybe if you are doing this, you may be starting slightly earlier than me, but I am coming up with 11. Regardless of your number, if it's exact or not, this is a relatively high number, so keep that in mind. And again, everything I say in this section, I do not want you to construe as bullish or bearish. I want you to just take every point by itself, separate, and think of it as one data point. So yes, according to VPOX, we're overextended. According to VPOX, it's been a lot of sessions in the last couple of months where we haven't had retests of the point of control, and that's what creates the VPOC. Obviously, the VPOC is the virgin point of control, which is simply the level on a daily market profile distribution where the greatest amount of volume traded in that particular session. It can also be measured as the greatest amount of time that was spent, meaning where the profile was the widest. I tend to use both in my analysis, but in terms of picking an absolute number of what I believe is the point of control, I always label it as the volume. So these VPOCs that you see are the areas of greatest volume in those sessions where subsequent sessions were not able to come back and sort of tag up. I like to use that baseball metaphor, tagging up they weren't able to tag up and touch that high volume node before moving forward. So we've got 11 of them. Usually if you've got just 4 or 5 of these VPOCs stacking, as I call it, that can be a sign that the market's getting ahead of itself. So certainly 11 VPOCs is significant. I would write that down and bring it into your narrative. All right. The other thing I want to point out here, and this is really the analysis that I've been leaning on most this week in writing my Peter's Pre-Market Perspective, where I dissect all this in the morning and I write a short report with the key levels and the scenarios and the narrative itself, and I get it out to people at 9 a.m. Before the market opens. One of the things that I've been leaning on is what I've been talking about as the proof that the market is bullish. I touched upon this a second ago when I started this section. As I was saying, there's a lot more to a market being bullish than just continually showing green on your screen or making higher highs. So let me point out a couple of things. And a lot of this has to deal with that concept that I often discuss, which is called WWSHD, right? And those of you who have been following me, and you can even call it, sometimes we call it hashtag WWSHD. Sometimes we joke that we're going to make bracelets out of that. But what it really means is when what should happen doesn't. And this is also straight out of Jim Dalton's playbook. I was just recently exchanging emails with him, and we were talking about the when what should happens doesn't, and he was reminding me that it's a concept that he's been talking about for years, that he often says that it's what the market doesn't do that is often far more important than what the market does. And again, in the narrative that has been building over the last couple of weeks, this is very, very important. So look at just these last couple of days, which I find, last few sessions, and we'll look at some when what should happen doesn't, and some ways that this market is just proving that it's very, very bullish. For instance, here, let's just go back into here. We'll start with here. Notice that this is a single print section. Now, generally, markets should violate single print sections and come down because there's very little resistance in a single print section. The single print section is also sitting on top of a very large gap, right? Very, very large gap, which is this section here. All of this is one big gap. And notice that inside of this, all of this, none of this has been retraced. So right off the bat, you have a WWSHD moment because gaps should fill, but this one didn't. So notice that when we start to talk in terms of narrative, we're going to pretend, and because the narrative can go from however far back you want, but just for simplicity's sake, let's just start the narrative here. Pretend that this is a book called S&P or ES, and the opening chapter is right here, and it starts with the gap. So the gap happens, and the gap doesn't fill. And single prints are left here. And then what happens? Again, we're thinking what should happen, move here into the single prints. But instead of doing that, the market balances. And it gives us 3 days worth of balance. Balance is, of course, where value is overlapping, value is unchanged, and the ranges of each day are relatively equal, right? Inside of that, and again, we're going to get very granular, poor high needs to be repaired. It then does get repaired, right? What is a poor high? It's where there is the lack of excess on top. So you have a balance here with a poor high, kind of a relatively poor low here, only 2 ticks of excess, another poor low here. What does this tell us? Again, the market is giving us tons of market-generated information as it's trading here. As I'm seeing these poor highs, poor lows develop, I'm already thinking in my mind that the odds of moving lower are constantly decreasing, that the market is not going to fill this gap at all, because if it was, it would already be having at least a little bit of price exploration to there and not creating patterns that look like this, which is like a poor low. And what does the poor low tell us? Well, think about it. The poor low is telling us that without that excess, you have a lot of shorts at bad location. And shorts at bad location spells what? Short covering, which spells higher prices. So you got to think about all this stuff as it's happening. This is how you bring the narrative together. And we leave a VPOC here as we break out of the balance and we start to move up. Not too much to say about these sessions here. Here we have an expansion of range to the upside. And again, talking about when what should happen doesn't. Poor structure, very poor structure. Meaning that The point of control didn't migrate higher on this day. So we carry forward that, you know what, this day was a breakout, but it wasn't that hot. Market closed in the upper third of the range, but it kind of did it on a spiky manner. We call those spike rules. So you put the spike rules in play. And again, you can find all these definitions on our website. This is a spike in our glossary at the footer of our site. Spike rules tell us that where the market opens, the next session will be very, very important. And if the prices find acceptance like this, inside of the spike, that's a very bullish outcome. It's not the most bullish outcome, because the most bullish outcome would be to have value higher. But again, we break out of balance, we move up, we have a spike, we have poor structure, but guess what? The poor structure does not get repaired. We don't have this day doing this and coming deep down into here and having some value here at the low end of the single prints. It only comes to here, has an excess low, value is higher, and again, kind of balancing to higher. Leaving a VPOC there. Here, again, poor structure, but does it lead to lower prices, right? You have a lack of point of control going up, or lack of point of control migrating higher. Does it lead to any higher prices? No. In fact, and again, adding on to the narrative, why did the market not, at the very least, retrace to here overnight in this session? Not only did it not go there, but it did a classic 45-degree line and a very, very squat, tight overnight session. Squat and tight overnight sessions tell us that the market is in balance, and it tells us that the market is accepting whatever higher prices or, stronger close that we had in the prior session. I find that very, very interesting. You have this sort of situation. The next day, we fall back a little bit. We actually open here. And we do get a little bit of selling because we come back where? We come back all the way into here. But also note that in coming in, where did we come into? An area right here where, and this is also a volume POC, where there was a high volume node before. So this tells us also that the market is bullish and has lots of momentum traders buying at very nuanced areas and letting the market come back in, right, to an area where there was higher volume and rallying from there. And it closes kind of weak here. So now, think about it. We've already been up probably 13 days in a row at this point or whatever. There's a lot of people probably thinking, aha, this has got to be looked at as bearish. It's kind of like an engulfing candle, right? All of this range is inside, and this one closed lower, you closed here. Interesting. But I'm seeing it a different way. As this was closing on this day, what I noticed was, okay, so if it's going to be bearish, and if this structure, there was some people with bad location up here in the spike, why did this low only go to here? And also, why did we reverse and close all the way here? You would think if, all of this, there's probably a lot of value here. There's plenty of traders that traded here. Why not lower? So it doesn't go lower. It closes there. And then, very noteworthy in the narrative, I added it right in, talked about it in the pre-market perspective. Boom. Back-to-back 45-degree lines. And big caveat here that I always say, and those of you that have been following for a while, you probably know what I'm going to say, but I have to say it anyway. The overnight distribution pattern doesn't mean as much as a regular trading hour session, but you would be a fool to ignore it. When I come into a session and I see a 45-degree line that is telling me that the sellers at the lower end of the overnight range are stuffed and they're painted themselves into a corner and they have poor location, tells me that there's a chance for that market to move higher. And lo and behold, what happens, right? The very next day, we negate all of this downward action by opening right here. And when we open there on overnight inventory, that is almost 100% net long, right? We judge the overnight inventory like this. How much is above the settlement and how much is below the settlement. And this overnight inventory is almost 100% net long. Let's call it, what would you call it? Maybe 95? Maybe that's 95% of the action. That's 5% of the action. Maybe a little more, maybe 90-10. But regardless, heavily skewed to the upside. Again, when what should happen doesn't. When the overnight inventory is heavily skewed to the upside, there is always the potential that early trade will reverse it. The hands that trade overnight are weak. They are weak. They trade overnight. They trade in small size. They are weak hands. They are most susceptible to the concept that I call shock and awe when they wake up in the morning and they were short somewhere in here, and then they wake up and it's here and they're in trouble. There are also plenty of longs in here, okay, who are buyers, not just short covers, but they're natural buyers. But again, they are weak-handed buyers, and they're happy to see the market open higher or somewhere near where their location is. But if they don't get upward action right away, they are going to liquidate. This is the basic reason why gaps fill in the market. When you see a lack of gap fill, that's extremely bullish. What does the market do? Fills none of the gap, goes down exactly 2 ticks, and boom, leaves another VPOC. Again, every day, market-generated information adding on to our narrative, not the bullshit that you see on television telling you, oh, this market's so bullish, it's going up. And they're talking about interest rates, and they're talking about the 10-year yield, and this and that. That is not what is happening in the markets. This is what is happening in the markets, okay? The constant interplay between those individuals who have long time frames and those individuals who have short time frames and how they transact. And only these charts will show you the exact footprints of how those people transact. Regular charts will not show that to you, all right? I'll stop ranting and I will continue on. VPOC number 10 gets left there, brings us to April 15th. All right, bullish day. As I said here, we have another back-to-back 45-degree line, and brings us right here to Friday, and we close, not bad. We close up here, not bad, decent day, kind of a balancing to up day. Exactly the type of day you would expect on a monthly options expiry. And we did make a fresh high. We did take out the overnight high, so that is bullish. And then last but not least, I'm going to point out 2 last nuances here. We have 2 week lows, and this is important. And again, this week low, not as important because it is a overnight week low. This one a little bit more important because it is a regular trading hours week low. What is a week low? Remember, a week low is not the same thing as a poor low. A poor low is a structural deficiency where the low has a lack of excess. Again, all of these terms are defined on my website at ShadowTrader.net. If you are a subscriber to Peter's Pre-Market Perspective, where I write a report on this narrative every single morning for the low price of $20 a month, you can just mouse over any of these tabs, as you can see right here, and all of these things will be defined for you. The weak low, again, as opposed to the poor low, is a situation where prices reversed course abruptly at very, very nuanced levels, be they technical or market profile. When I say very nuanced, I mean things that only the shortest term traders would know about, and sometimes even they don't know about them. It's just a self-fulfilling prophecy that prices turn there, that buyers overcome sellers or sellers overcome buyers at some of these natural levels. So what is this week low? It is the exact midpoint of this RTH session. This little goldenrod line, as I call it here, that's halfback. So the overnight trade pulled in right to the 50% mark here where the midpoint of this range was, and that's where the sellers got stuff and created the 45-degree line. Whereas the other week low, it's right here. When Friday's low came in right here to where? Right to the settlement and stopped. And another thing I want to point out as well in terms of Friday, what I was watching is Friday was a gap up. It was a classic gap open. You opened here. The natural gap fill would be to here. I had a very good feeling this gap fill was going to happen in this session, and it did. The gap filled. Then prices didn't stop. They went lower. So as soon as prices went lower from here, after the gap fill, there is potential that they will go to the next signpost, which is the settlement. The first signpost would be the value area high. Next signpost would be the settlement. Third signpost would be the point of control, and you just keep going on and on and on. This is how I feel that everybody should be looking at day time frame trade when you're trying to effectuate it and looking for targets or thinking about where the market goes or doesn't go. You should be thinking about signposts the whole time. So the point I want to make here in terms of what happened on Friday morning is that the gap filled and we went further. But in going further, what was the market doing? Well, at the time, I was watching very closely. The tempo slowed down considerably. Volume tapered until it went to 76 contracts at the low. And then where did the low price stop? Again, at a very nuanced level, right on the settlement. And I mentioned this exact thing in a What's Peter Thinking audio message to the Weekly Options Advisory subscribers on Friday. I believe my exact wording was, Goldman Sachs is not sitting on the bid at the prior day's close, right? What kind of traders are buying these kind of lows, are reversing there? It's not the bigger players. So that leads me into the conclusion of this portion of the presentation, which is twofold. One, understand that momentum traders are in control of this market right now. That can last for very long periods of time and is not generally bearish. It just means that people are hyped up about stocks right now, and it just feels like the longer term players are buying and holding, and they're just in, they're not doing anything, and you have shorter term money chasing the market, as you can see these very nuanced pullbacks and also failure to test virgin points of control, et cetera, et cetera. You got VPOC stacking, you have these nuances like weak lows, et cetera, right? Markets basically failing to do some things that I think it would be doing if there was more evidence of a longer term type of money in the market. That's point number one. Point number two in concluding this section is simply keep all of these deficiencies in your narrative so that you have signposts to look at if the market starts to correct. On a very, very short term level, here at the very least is news you can use early next week. If this market comes off Sunday night and starts to come in more Monday, pay attention to these two levels, because when the weak low gets violated, you should probably short it. Because remember, there are very, very weak longs at the weak low. The weak low is absolutely not a level that the market is going to defend. That's how you play a weak low, is you look for the retest of that weak low and you use it as a short point. So let's say that we opened somewhere in here on Monday. I'm just throwing out an example of a potential scenario, and we trade lower and the momentum is pretty good. The tempo is medium to, fast, meaning you've got some oomph to it. A very slow tempo is not good. If it's very plodding and just kind of grinding, it's probably not going to go. So you have a quicker tempo, you have bearish internals, and you take out this low. Okay, you short the ES and you run it down to here. You go 61 to 58. And then you see what happens at this virgin point of control that hasn't been tested yet. And, maybe it goes lower. Okay, it goes to here. Okay, wonderful. 54. Okay, let's go to 49. And you just keep thinking sequentially like this of these signposts. And these signposts can be on a very granular level like I'm talking now, or they can be on a bigger level such as with VPOCs, right? Let's say the market comes in majorly and the S&P decides that it wants to pull in 200 points or whatever. Well, probably a number of these 11 virgin points of control are going to get taken out. And in that case, you don't look at, you stop looking at nuances like weak lows or pullbacks to highs or, closes or halfbacks or things like that. You just shift your focus to the virgin points of control. The market's really coming in hard. You just say, okay, there's VPOC 11. Where's VPOC 10? Okay, now we're going to 10. Now we're going to 9, right? And that's basically it, all right? So I hope this is of help to you. As always, I always say, if you want to get this analysis every single day, obviously in a much shorter version. I know that I talked about this for a very long time in this section of the video, but if you'd like to get this every day condensed down into something that you can read in literally less than 2 to 3 minutes every single morning, I urge you to definitely check out my Peter's Pre-Market Perspective on our website. Just mouse over the Futures Market Profile tab, as you can see, and select the Peter's Pre-Market Perspective there. And again, very, very reasonable. It costs you about $1 a day, but I do believe that it will be some of the best money ever spent, because it will get you looking at the market in a completely different fashion and also arm you with some knowledge that very, very few people possess. And this is really a game of organizing information. I'll just leave you on another classic Daltonism that my mentor in the profile, James Dalton, always said, and his exact words were, organize information better than the next guy. All right, let's talk about sectors. This is one of the things that is also keeping this market so bullish. So we're going to start obviously with the granddaddy of them all, which is the XLK. I call it that only because it is the largest weight in the S&P. We're going to look at those 11 sectors, not all of them, but the majority of those 11 that make up the S&P 500. Obviously, the XLK, being that it is technology, is going to have a very similar pattern to the NASDAQ 100, as I talked about earlier, just starting to break. There's not much I can say about this other than that, it's going to kind of look like the NDX, and to me, it looks very, very strong. Let's look at some others. XLV is very, very important to the S&P. Very recent breakout here. Early in the breakout is a little bit overextended, I think, from the 20, but certainly, this is worth a lot of weight in the S&P and looks good. Communications as well. I like this pattern, just kind of a sideways action. And this is indicative of that whole push-pull that I'm talking about, where the sector rotation has just been huge lately. And even in a bigger picture, the rotation between majors has been huge lately, where we constantly see divergence between NASDAQ 100 very strong one day with S&P weak, and then it flips. And again, I can't stress enough how bullish this is for the market, because this constant passing of the baton sort of keeps the race running. It keeps it going. There's always somebody waiting in the wings that has rested and then steps in and wants to, move the baton forward. And so think of communications as just kind of resting here. And then at some point, the baton is going to be passed to them, and they will move higher. Let's look at financials. XLF. Same thing, just kind of a slow grind to the upside. Looks good. That could easily break higher. Let's look at XLY, which is consumer discretionary. Again, just pushing higher. Decent weight in the S&P. XLI, industrials, looks very similar to the Dow, as it should. Not very overextended. XLP, just breaking out now. So notice that while the market was more bullish, staple stocks were going sideways, and then all of a sudden they just start to go. So this should continue to the upside. And again, what does that do? It helps the S&P. And last but not least, I want to end on utilities. They're not a very large weight in the S&P, only a couple of percent, but they're stronger than I'd like to see them. And it's just one data point, but I thought maybe we should just carry that forward. If you look at the monthly, or let's just look at the weekly first. They're not yet up at highs like the market is. Usually what it is, when you look at this thing with utilities and you want to see utilities kind of hanging back as the market is going up, you really only need to be worried if the utilities are like making a new high, like ahead of the market or with the market. In this case, they're still pretty far behind the S&P in terms of that, but just something to think about. I'll be the first one to admit that they're stronger than I'd like to see. Rates have come in a little bit recently, so that could be the case. But, one data point, keep it in mind. Utilities are definitely strengthening up a bit. All right, so last but not least, let's look at gold, Bitcoin, and Coinbase, all of which are certainly newsworthy at the moment. Gold has been asleep for a long time, but I wanted to point out that it might be waking up. This area is actually quite interesting. If you look at the weekly chart, it's a longer-term trend line, and you kind of tested it twice. And when you retested, you made that weekly hammer, which I like. I always say I'm kind of a big believer in the hammers only on the weekly. I don't really care about that pattern on any time frame shorter than an entire week, but it did do that. And since then, it has actually had some follow through for 2 weeks, which is a shocker, because gold is classically like 1 week up, 1 week down. It just kind of does this all the time. So it's actually moving up. I am still very disillusioned with it. I do think it's like what I call the heartbreaker trade. It's hard to make money with. I would say just keep it on your radar. This wedge seems to be tightening. And, if it continues to dribble up to here and eventually reaches the downtrend, then maybe there's a trade. But I think personally it feels to me like cryptos have taken a lot of the thunder away from gold as a store of value and also as a potential inflation hedge. And so let's look at that. BTC, new highs in this past week, all the way up to 65,520, which is just fantastic. And since then, consolidating. I will be looking for a pullback buy at the 20, at the 50, or anywhere at the trend line, or maybe even at this prior low. I just think all pullbacks are buyable. in Bitcoin. There is a short-term trend line you should pay attention to as well that kind of intersects with a lot of that stuff right in here at around the 56,000 area where that pullback is. So I would keep that in mind. As you know, I'm very bullish on the crypto. And last but not least, last week's video was all about coin. Thank you so much to all of you who watched. It was one of the highest views I've had in a very, very long time. As I speak to you now, almost 90,000 people have viewed the Coinbase video, and I hope that it helped you and also brought to light the pattern that I talked about towards the end of the video, talking about generally how IPOs will go down early, which this one did. They usually fall on the first day. Coinbase was no difference. It kind of fell hard. The volume was huge. And then it went down a little more, but did not make a lower low. And on Friday, we had a little bit of a green day. But again, what does this need? Nothing but time. It needs to build out in this direction. And just to reiterate what I was saying before, that the better longer term play is simply to wait for the opening price, which in this case, if I remember correctly, was 381. So you can wait for 381 to buy Coinbase for the long term, or you can wait until it crosses over the high that was made in the IPO trade, so to speak, or since it's been open. That high is all the way up here around the 430 area. All right, so be safe. It doesn't make sense often to try to pick bottoms unless you are going to average your price in, unless you feel that this is a very, very long-term trade for you. And you are willing to say, okay, I will commit a quarter position at the 330 level, and if I see a little bit lower, I'll commit another quarter, and then whatever, if we go higher, maybe you draw a downtrend line in some way, and you say, okay, I'm going to commit on a break of a downtrend, and then I'll commit the last piece when we cross over the opening price. Things like that. These are the ways that I think are much better to look at a longer term investment in a stock, rather than just jump the gun and be long on the first day of the IPO or whatever. And that's all for this week. Thank you as always for spending a little bit of your weekend with me. So a lot of that discussion in the market profile section of the video, I will admit, was a little bit long-winded, but I feel like it was important to illustrate how deep one can go with the narrative and how long the narrative can be, and how basically valuable it is to continually add to that narrative and bring it forward and carry forward market-generated information into the new day, because it arms you with so much knowledge and power that you need to basically look at the market the right way in those subsequent sessions. And I think that's really the key to this whole game. It's basically, as I said in the video, organize that information better than the next person, and that basically gives you a huge edge on on everyone else out there. To recap that whole section and a lot of the TA that I talked about, what I want you guys to take home into next week's trade is basically a couple of points. One, obviously, the ruling reason is get it higher, right? That's the spirit of the time, however you want to talk about it, ruling reason. It's get it higher. That means more than anything else out there. That is going to be above and beyond anything else that is happening. So obviously the market wants higher. The thing out there is just get it higher, and it's doing it. But as it's doing it, there is strong evidence that it is a lot of shorter term traders and a lot of momentum players. But remember, this does not mean that the market has to collapse here. It can often lead only to liquidation breaks, which are very, very short-lived. That in and of itself is a very, very important thing to know and understand, and be able to spot and be able to know the difference between real selling and a liquidation break, all right? I talk about these things live in real time with my weekly options advisory subscribers all the time. Tons of people email me all the time and say, how valuable, I held on to my Apple because of what you said. I didn't sell my Google. I'm still holding my etc. stock, whatever, because you correctly pointed out that this was just a liquidation break and there's nothing to worry about, all right? So I'll give you a freebie right here. Take this information into next week. When it's a liquidation break, how is it going to happen? One, it's going to come out of nowhere, meaning the market's going to have a bullish pattern. It's not going to look bearish at all. It's not even going to maybe look so toppy. It's usually just kind of consolidating, and boom, the market starts falling out of nowhere, okay? When that happens, The tempo, meaning the speed of the tape, the speed of the transactions preceding the liquidation break, is usually slow to middling. And when the liquidation break starts to occur, the tempo increases greatly. Okay, so you have a faster tempo than you saw before. Next is the liquidation break is going to be short-lived. It will usually only last maybe a half hour, an hour, maybe a couple of hours, and it will turn. And when it will turn on a dime, on a very sharp V-shaped reversal, usually at a very, very technical level. Okay, so it'll go to, some sort of nuanced level, prior day's low or whatever, but it's some sort of technical level it will turn at. That's a signal in and of itself, because remember, stronger sellers do not stop at technical levels. They just keep hammering it lower. Okay, and last but not least, this is very important, as it's coming down, you will not see confirming context of very bearish internals. It's very common that people will get very sucked into a liquidation break because why? They only look at price. But remember, price is nothing more than an advertising mechanism, and it will fool you every time. And they don't look at internals. They don't look at what's happening contextually. So in a typical liquidation break, very often it will look hot and heavy price-wise because price is moving fast and price is moving down. But for instance, there'll be no perceptible shift in breadth on the New York Stock Exchange. There will be no perceptible shift in breadth on the NASDAQ. The advanced decline lines will collapse only a little, but they will often even stay positive. They'll be up at plus 600, plus 1,000, and they'll come into like plus 300, okay? Ticks on the New York Stock Exchange, most important, will not register minus 1,000 ticks. Or maybe if they do, maybe the break will stay on for like 2 hours and they'll only register one minus 1,000 tick. But I've seen many liquidation breaks where they don't even register a minus 1,000 tick, and you're looking at it and you're seeing that the price looks bearish, but the low tick on the NYSE was minus 600 or something like that, some very benign reading. So all of these are contextual clues that are very, very important to understand when a liquidation break is occurring and when stronger selling is occurring. One other thing I'll add to that is typically liquidation breaks will not have participation from all sectors at the same time. So that means that when you look at your sector minder of those 11 sectors that make up the S&P, they will often have a smattering of green on it. So you'll have a number of sectors driving the down move, but not everything is red. That's also important. Remember, when the real selling starts, when the you-know-what really hits the fan, okay, no sectors are green. Same thing with sectors, okay? You're not going to have, in a liquidation break, it's common that, only the NASDAQ and S&P maybe are down or whatever, but the Russell's still green. Again, true selling doesn't act like that. It gets a little bit more hot and heavy, all right? So, recap all that, you got it, but as I was saying before, if you'd like me to hold your hand through this every day, as it happens, okay? Pointing these things out, extremely valuable. There's your link right there, shadowtrader.net/options. Still the best deal on the street, $49 a month. Live trades in real time, all to your mobile. Live sessions that we do, What's Peter Thinking? Audio messages throughout the day. Private webinar on Thursdays. Ask me questions all day long if you like. And last but not least, also that whole market profile analysis that I talked about. Market profile report every single morning, Peter's pre-market perspective. I throw that in for free as well. On behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.